Welcome to Finance in 5. What is going on with Gamestop? Well, a lot of things. The maligned console retailer, which I've done a few videos about on this channel much to the amusement of naysayers, has seen its share price rocket upwards in recent days. It now hovers around the $8 mark. Check out this price chart. There's been a fairly rapid uptick in the value of GameStop's share price ever since August the 31st, when Ryan Cohen, founder of the pet store Chewy, bought 6.2 million shares in GameStop. What is going to happen? Is this an opportunity? How can you get involved? Coming up today on Finance in 5. I've spoken before about GameStop on this channel and how its share price is likely to respond positively to the upcoming console release cycle, including Sony PS5 and the new Xbox X. I mentioned Burry's involvement as an activist investor and noted that he sold some shares earlier this year. Many concluded that while Burry took relatively meager profits, it was only a matter of time before he would abandon ship and dump the stock altogether like he did with Tailored Brands. Very few would entertain my counter-narrative that GameStop has well-controlled debt and robust cash flow potential. I reiterated that its price would rally and that the lockdown was actually bullish for legacy console gaming, despite the rise of digital equivalents. Many people either ignored these thoughts completely or smiled politely and moved on with their day. But now we know that not only has Ryan Cohen, in conjunction with RC Ventures, disclosed the purchase this month of 6.2 million shares in several 13D filings at prices ranging from $4.60 to $6.73 a share, such that Cohen owns 9.6% of GameStop's shares outstanding. But the stock is going up and up and up in price. It went from $5.36 on Friday, August the 28th to $7.65 on Friday, September the 4th, a rise of 42.9% in just 7 days. And according to many analysts, it could go a heck of a lot higher than that. Why would Cohen buy in? Good question. The filing said that he acquired the GameStop stake based on a view that the stock was undervalued and represented an attractive investment opportunity. The filing said he could buy more shares and that he could make proposals on changes in the company's ownership structure or strategy. Ryan Cohen, according to Wikipedia and Forbes, is the co-founder and former CEO of e-commerce company Chewy, which was acquired by PetSmart in 2017 for $3.35 billion. In 2011, Cohen founded Chewy under its original name of Mr. Chewy. When he was 25 years old, he originally approached over 100 venture capital firms and was rejected by all of them. Finally, in 2013, Cohen secured the company's first outside investment from Volition Capital for $15 million. By 2016, he'd raised capital from investors including BlackRock and T. Rowe Price New Horizons Fund. That year, the company had $900 million in sales and had become the #1 online pet retailer. By 2017, Cohen had raised $350 million and was preparing for an IPO. In April 2017, PetSmart purchased Chewy for $3.35 billion in the largest e-commerce acquisition of all time. Cohen remained CEO following the acquisition and operated the business largely as an independent unit of PetSmart.
Ryan, you got to be kidding me. This isn't going to work.
We didn't have any investors. I mean, I went to Silicon Valley. It took me over 2 years to finance the business. Over 100 investors passed, lots of no's, the demise of Pets.com, going head-to-head against Amazon and vertically integrated e-commerce. But we kept on scaling the business. It was just heads down, blocking, tackling, focusing on amazing execution. And I think everyone underestimated how well we would execute and how big of a business we could build.
You're still going up against Amazon.com.
Yeah.
That is a confident man, people, yes. So what, because you know that they're looking at you and thinking, no, they're not taking any piece of our pet business.
Yeah, I mean, the vision for the company was really to replicate the experience I had in the neighborhood pet store, but do it online and do it at scale. And so, the handwritten holiday cards from the beginning, the pet portraits, the flowers, doing all these things to really delight our customers and show our customers we're bringing a face to e-commerce. And within a category like pet, where customers are so fanatical, all of those small things just create this loyalty. And once customers shop at Chewy, they continue shopping at Chewy and they tell all their friends and family about this incredible experience.
What makes you think the market will be there next year?
I mean, it's just a game of scale within e-commerce. And so you need enough revenues to get to your fixed costs. You need enough velocity with your suppliers. You need enough fulfillment centers around the country. I mean, Chewy has 7 fulfillment centers, 11 million active customers, did $3.5 billion in revenue in 2018. So if you wanted to replicate that model, sure, with enough capital, it's possible, but it would require significantly more capital than we had invested.
Following the sale of Chewy, Cohen made significant investments into Apple and Wells Fargo. His Apple investment has made him the largest individual shareholder of the tech company, with 1.55 million shares as of August 31st, 2020. In June 2019, Chewy went public at a valuation of $8.7 billion. So that's all very wonderful. He's obviously had some tremendous success at taking a pet business effectively from nothing into a sizable valuation in a fairly short space of time by using seed funding to help it sell online. That success is reflected in Chewy's share price, which we see here. Investors will be hoping that he redirects those skills towards transforming GameStop's fortunes. But for the past 5 years, GameStop's business has been in decline due to an industry transition towards digital retail. Dubbed the blockbuster of gaming, GameStop has been slow to respond to the ongoing shift in consumer behavior. Some problems GameStop has encountered include poor public perception, weak management, low reinvestment, low morale among employees, expensive, ill-thought-out mergers and acquisition strategies, expensive dividend, which doesn't exist anymore, declining revenues, poor marketing efforts, a poorly designed website, rapid management turnover, and lack of a comprehensive go-forward business strategy. Apart from all of those things, everything is peachy. Yes, things look dire, and short sellers have capitalized on this fact over the past few years, as we can see in GameStop's declining share price, which this chart shows. We also see just how many short sellers there have been since 2016. They've piled into this trade, emboldened by 5 years of consistent returns. GameStop is one of the most shorted stocks ever. It's on the very right-hand side in this graphic. On the plus side, though, there have been several positive catalysts. One analyst in particular, Jonathan Prather from Seeking Alpha, lays out in a table here the possibility of GameStop's shares eventually exceeding $50 each in a little over 2 months' time. He says, GameStop executed its debt exchange flawlessly. The company has made improvements in its vendor relationships and is poised to generate meaningful free cash flow during the upcoming console cycle. They can expand high-margin digital sales, close less profitable stores, reducing long-term debt from leases, and pay down debt with excess cash on hand. They have the ability to buy back shares, and they don't pay a dividend, allowing them to reinvest in the business. They also hold a unique position within the thriving video game industry, and I believe they could be a genuine buyout target for a larger digital retailer looking for brick and mortar exposure. GameStop could go to zero over the next 3 to 5 years, and this is the view of many people, not just short sellers, but many analysts and many observers of the industry. Management could fail to turn the business around. It could destroy all remaining equity value in the business. This transition to digital retail could accelerate very quickly, especially in a COVID-19 world where people don't want to frequent physical retailers. GameStop faces a lot of uphill battles. How will they generate cash flow post-console cycle? Have they learned how to sustain profitability during off-cycle years? Is the console cycle going to be as beneficial as they expect it to be? If they don't have a clear path forward and a strategic vision, they're going to falter. So it's not obvious that GameStop will stage a successful turnaround. However, they may have the tools and the leadership potentially to make it happen. And this is where we move on to talking about call options, which is a subject that we brought up recently on this channel. They're popular amongst folks who are expecting an imminent rise in a company's share price based on one or more pending catalysts. And the analyst I mentioned, Jonathan Prather, has done several articles about his own personal call option position in GameStop, which he has taken on recently. Let's look at his strategy. He specifically is using January dated calls because apparently they provide ample time for his thesis to play out. The risk of options expiring worthless, as we've talked about, is quite real and could potentially result in a total loss of investment. This isn't a conservative play by any means, but in the event of a short squeeze, it benefits from an increase in volatility in share price. In the past year, GameStop has made a concerted effort to redirect the focus of the business. As part of this effort, it's made substantial changes to reshape its board of directors, with successful industry veterans, GameStop was the subject of a dramatic activist proxy battle in which hedge funds Hestia Capital Partners and Permit Capital Enterprise Fund elected to vote Paul Evans and Curtis Wolf. In March 2020, GameStop announced that it appointed 3 new independent members to its board of directors: Reginald Reggie Phils Aim, William Bill Simon, and James J.K. Simonsick. In June 2020, activist investors won 2 board seats. Let's focus on J.K. Simonsick. Just like J.K. Rowling, the J.K. stand for James Kevin. So James Kevin Simonsick has 25 years of executive leadership and operational experience in the retail and consumer product industries. He served as president and CEO of PetSmart Inc. since 2018, which would appear to link him to Mr. Ryan Cohen, who we've mentioned. Mr. Simonsick previously served as president and CEO of Academy Sports and Outdoors, a retail and e-commerce sporting goods chain from 2015 to 2018. So here we see an interesting table which shows us that insiders primarily have been purchasers of large chunks of GameStop shares. It seems more likely than not that Ryan Cohen has some sort of agenda beyond simple passive ownership of GameStop, based on several factors. 1, his pre-existing relationship with James Kevin Simonsick of PetSmart and Chewy. 2, this aggressive share purchase and 9.6% ownership of the company. 3, Cohen's historical lack of diversification. He's only really focused on a very small number of companies. So what might be going on? Here are some possibilities. 1, he could be pursuing a buyout of the company. 2, he could be teaming up with an old colleague to help grow this new business venture. 3, he could be advising or consulting on growing the e-commerce portion of this business. 4, he might believe the company is undervalued and a good investment opportunity. The figures in the tables here show us fairly clearly that GameStop has ample cash on hand to make it through another console cycle. According to several analysts, and comparing GameStop with peers of a similar market capitalization, they could eventually be worth $40 to $50 per share. Obviously, this depends on them proving viability, but with a strategic shift and the involvement of Mr. Ryan Cohen, some believe they could pull it off. Couple that with expected cash influx from the upcoming console cycle, and things begin to look a little brighter for the stock price in the short to medium term. As far as the short squeeze is concerned, this refers to the possibility that buyers of short positions will dump the stock en masse while retail participants bid the price up. There are several historical comparisons which include Volkswagen and a company called Blue Apron. Blue Apron stock went from $2.25 to $28.84 in 4 days, despite having short interest well below GameStop's current levels of short interest. Blue Apron had only 10 million shares outstanding, but look here at the volume once the short squeeze finally happened, plus the accompanying 600+% run-up in the stock price which occurred over just 1 day between March 17th and March the 18th. So when it comes to any kind of action that you can take on the back of all of this discussion, it really depends on your belief in the company's fundamentals as well as your ability to tolerate risk. If you have a high tolerance for risk, the recommendation of Mr. Prather is for investors to make a small bet on the money call options with expiration dates that you see here. Next week clearly is extremely important because GameStop releases its latest earnings report and pre-orders are open for the new consoles. If you're going to get involved in investing in GameStop, it may be wise to do it soon because the coming price action could make this week's 43% spike upwards look like a drop in the ocean. Thanks very much for watching, and I'll see you next time.